Well, thanks for tuning into Talking Point. I'm your host, Neeraj Chan. We couldn't have asked for a better time to get James Sullivan. He's head of APAC equity research at JPMorgan. And he joins us right now on the sidelines of the JPMorgan Investor Summit to talk about his thoughts on what all the variables around the investing world are currently and the impact thereof. James, great having you. Thanks so much for joining in. I'm going to request my team at BloombergQuint to just put their camera on, put their microphone on mute before we start this conversation so that there's no disturbance later on. But James, thank you so much, and I hope all is safe.
Thank you very much for having me on the program. All good so far. Looking forward to talking with you.
Likewise. James, what's your sense? I mean, let's park Fed for the second half of the conversation. I want to first talk about how do you see the APAC region and the things happening in China and the spillover effects thereof, both positive and negative. Let's start off with Evergrande, because that's top of mind for everybody. And you would have been asked by so many of your clients, right, about how do you see this? So let me ask you, how do you see this?
No, look, it's a great opening question. One of the benefits of working at JPMorgan is that we get a fantastic cross-asset platform and very, very smart people to talk with. So we literally just got off the phone with our equity, credit, commodities, rates analysts, as well as strategists talking about Evergrande's impact on China as well as the region. Clearly, this is a topic that's top of mind for many of our clients. We had over 1,000 investors dialed into that call. A couple of key conclusions. Number one, this is not an idiosyncratic or company-specific issue. This is a structural issue that will impact the Chinese property space on an ongoing basis for a significant period of time. And that's an important statement because once Evergrande goes away, this problem is not over. What we have in China today is a system that is over-levered, is a system that has extra capacity in the overall country in terms of overall housing starts, is a system that is facing a decline in terms of incremental housing requirements on a go-forward basis. The story of China for the past 20 to 30 years has been a story of significant urbanization combined with some degree of household formulation. Urbanization isn't done, but clearly the second derivative rate of change is negative, not positive. The overall population growth story is obviously very well known. And so this is an element of Chinese society, which has been a significant contributor to overall GDP and economic growth that is going to structurally slow on a go-forward basis. You add to that very high leverage in the system, you have a workout ahead of us. We don't see this as something that will trigger contagion into the rest of the region. The large degree of debt is held onshore. There is offshore borrowing involved, which sits relatively low in the capital chain. However, that debt, in the case of Evergrande, is now trading at 20 to 30 cents on the dollar. You have other semi-distressed debt for other companies in the space that's currently trading at 50 to 60 cents on the dollar in the bond market today. But it represents an efficient market reaction to the reality on the ground.
It does. Just a couple of follow-ups on this. First, the very near term, there is an overarching view in 2 or 3 notes and articles that I read, James, and would love your view here, that if Evergrande is restructured, then there is no large spillover, but if there is liquidation, then there is potential contagion across multiple verticals. Would you believe that would be the case, and how would you expect, or how is it possible to explain what the potential impact could be in either or scenario?
So again, very good question. It depends on the definition of restructure. Do we think that we will see a relatively orderly wind down of the situation? Yes. Does that mean that every investor in debt and equity will come out of this situation whole? No. The offshore investors will clearly have to take a haircut on the debt that has already clearly been priced into bonds that are trading, as we just said, at 20 cents on the dollar. Will there be losses onshore? Yes. Can the Chinese government afford to have Evergrande seize up? Given its prominence in the development market, given the number of Chinese citizens involved, the answer to that question is most likely no. And so there will be orderly wind downs, or there will be orderly restructuring of portions of this portfolio. But again, I don't want to imply that there will not be losses taken. That limits the contagion across the rest of the system. What I would suggest, however, is that the more important question is not the immediate term, what will happen to Evergrande. The more interesting conversation here is, how do we think about the structure of economic growth in China? How do we think about the structure of taxation in China? One of the topics of conversation on our call with investors several moments ago was this idea that the reality of having the largest percentage of an individual's net worth tied up in their house is certainly not unique to China. That exists in most countries in the world. Now, homeownership in China is extremely high, and so it's a significant issue, but that's not China specific. What that means, however, is that from a political perspective, a significant decline in home prices is significantly more negative than a significant spike in home prices. And so there's an asymmetry to the risk perspective from a Chinese government perspective. The element of this story that is unique to China, however, is the percent of particularly local government tax receipts or local government revenue raising that comes out of property sales, which we've all talked about in the past and is relatively well known. What this does imply, however, on a go-forward basis, is that the Chinese government may have to seriously rethink the structure of revenue generation in the country. The overall amount of revenue that's driven by both the central as well as local governments off the back of income, corporate, and property taxes, the way we think of them in many other countries, is extremely low relative to what we see in other OECD countries. And so that's the broader structural reform story that I think we'll be telling for probably the next 6 to 12 months.
And yeah, I mean, if I was sitting in China, and James, I would have asked you 3 or more follow-ups on that particular point. But I do have a follow-up on what this means for teams around the world that get impacted. It's a very pertinent thought about what happens to the Chinese economy if the biggest store of wealth kind of starts declining. But I want to check with you about what do you think of the quote-unquote contagion effect on, say, metals, on construction chemicals, etc. If indeed the Chinese property market were to, as a result of this, slow down a bit. Any thoughts here?
So we see limited opportunity for contagion, and that may be a contentious statement. The arguments that I would put forth that sit underneath that is, if I look at the capacity changes that we've seen in some of the large materials and infrastructure industry verticals in China over the course of the past 12 to 24 months, you have started to see a reduction in overall steel production capacity. You have started to see a reduction in some of the key verticals that feed into the construction industry. So those adjustments have already started to occur. And again, as we said, we do think offshore bond investors will likely take losses off of bonds across the spectrum, not just in Evergrande, but we see limited opportunity for that to trigger a financial contagion on a broader basis. Now, clearly, if there's a less orderly wind down of some of this risk, then that conversation changes. If you see a crashing property market in China, which is absolutely not our base case, to be clear, then that triggers a very different conversation. But under our base case scenario, we see limited incremental room for contagion.
Okay, so you don't necessarily believe that the metals, I mean, just purely this Evergrande issue to really blow cold the commodity rally that we've seen thus far. There could be other factors, of course, but Evergrande by itself will not really put a lid on the metal rally that we've seen.
No, and again, we've already seen, and again, it's a very, very interesting topic for conversation. We've already seen very significant adjustments in many industrial verticals. And one of the things that we've talked about to investors is this rotation out of the China steel space and into Japanese steel stocks, as an example. Because you're seeing this reduction in supply, you're seeing a greater pricing umbrella under which some of the cost competitive Japanese providers can operate as steel prices and overall commodity prices go up. And so it's really a country sector allocation conversation that we're having with investors.
Got it. James, can I ask you a follow-up on that point? There is, I think Bloomberg had an article today about a value investor believing that what China is doing on its tech piece could be great news for countries like India, which have gotten evolving and kind of coming to the fore tech space, so to say, with the IPOs that India has lined up. And not just IPOs, just the number of companies mushrooming out there. What's your sense here? The reason why, again, I believe this is important, James, is hitherto in India, tech was always defined as IT services, which never needed capital. It always gave out capital and bought bad equity. We are now starting to see the first signs of paper coming in, which is needing capital and is in the tech space. How do you kind of juxtapose the two?
So I would suggest 2 levels to the conversation: the status quo and the more immediate conversation. The status quo conversation, and I'll make some obvious statements here. The incremental total addressable market, or TAM, for internet platforms in South Asia as a whole, so that's ASEAN plus India, is significantly greater than the incremental growth opportunities in China, given significant historical growth and high penetration rates for many of these services in China. And so if an investor or a company is looking at these sectors from an incremental growth perspective, we do see very interesting and attractive opportunities in both ASEAN and India. And I think that that's very clear for a lot of investors. We have a corporate access event coming up next month where we have 50 to 60 Indian unicorn companies presenting to clients. We see that space right now valued somewhere north of $250 billion. And so very significant value creation that we're seeing across the board, Indonesia, India, et cetera. The second part of the conversation is from an investor perspective, investors care about growth, but they also care about risks to forecasts. How well can I understand the future? In China, the risks have risen. The overall government policy that falls under the broader policy umbrella of common prosperity is clearly impacting elements of the tech stack in multiple different ways. And it is creating policy uncertainty. You add to that privacy and personal data concerns, with the Chinese government just starting to regulate more aggressively and really catching up to some of the regulations that we've seen rest of the world. So we wouldn't necessarily see that as a negative. It's just incremental change, depending on which area of the regulatory stack you're talking about. But again, that increase in perceived risk in China drives significant investor interest along with that perception of growth in markets like Indonesia and India. You add to that, again, the more immediate conversation, where in our conversations with Indian government officials at the JPMorgan India Summit this week, we've heard about significant government support and very real and concrete policies, not just to support this commitment to a free and open internet in India, a common set of rules for both foreign as well as local companies. And so still room for operations for foreign companies in India, unlike some of the rest of the operating environments that we see across the rest of APAC, but also support across the tech stack. And so incremental support for things like semiconductor manufacturing and very real and concrete plans to support that industry on behalf of the Indian government. And so we're excited about what we hear. And if you put that into context of what we're seeing across the rest of Asia, we are already seeing a rotational trade out of other Asian markets, inclusive of China, and into South Asia, inclusive of both Indonesia as well as India.
And I guess from the first half of your answer that this is not a short-term phenomenon. You reckon this could last for some quarters, some years.
So it's an interesting combination of market opportunity in terms of that incremental growth that we just described, combined with a shorter term catalyst, which is this increase in perception of policy risk and uncertainty in markets like China. And so you get this nice confluence of events from an investor perspective to really drive interest. And at the same time, for the first time in 10 years, you have this plethora of Chinese internet companies that are coming to market, which present an opportunity for people to put that capital to work.
Yeah. My final question on this before we move to the Fed, and James, that is the belief in certain quarters that if there were to be, and it's kind of tied into rates, but the belief that if rates were to indeed move up, or if there is a belief that rates might move up, then the tech companies are the first ones to get hit on the valuation front. It is in this scenario that we're getting this bevy of Indian tech startups which are coming to IPO. Could there be a problem, or will there still be demand?
So look, it's a great question, and the essential backdrop of what I'm hearing in your question is an investor truism, which is as rates go up, you want to be cycling your funds into cyclicals, rate sensitive, so banks, industrial stocks, things of that nature, and out of growth sectors. We think that that's more true in a market like the United States, where we are looking for a change in tone out of the Fed this week. We are looking for a November tapering versus the current expectations in December. The second half of that conversation is equally important. We're expecting the potential for 4 25 basis point rate hikes in 2022 that is not built into the steepness of the yield curve yet. And so there are significant, not built into market price yet type moves that we're expecting out of the US. If you juxtaposition that with the conversation that we're currently having in India, inflation is running 80 basis points light relative to expectations. Yes, you have growth picking up, and the industrial production statistics that we saw last month coming in at 11.5% were significantly ahead of consensus, which was only slightly above 10%. So this growth pickup that you're seeing occur is significant, and the potential risk is that you start to build in inflationary expectations. But the critical element of this is that we're still coming off of a very low base. India, unlike the rest of Asia, is still sitting, depending on the numbers that you're looking at, 8 to 12% below pre-pandemic trend. It is one of the only markets in Asia that has this big pickup yet to occur. And so our argument to investors is don't be scared of that growth. It's unlikely to be inflationary for a period of time. The current inflation statistics are bearing that argument out. And so we do think that the RBI has significant runway before they're forced to move. So within an Indian context, you have a confluence of rising economic growth. You have a confluence of a very significant incremental addressable market. You also just get the repair of middle-class incomes across India. They were hit very hard during the downturn. We had significant levels of unemployment, which is slowly coming back. So again, a very interesting confluence of events, particularly when you put that into a regional context.
Interesting. James, what does, if indeed what you're saying does materialize, which is a November taper, which, well, some people argue may just be the first signs and not necessarily the actual one, or the more important thing, 4 rate hikes in 2022. I don't think even the dot plots are suggesting that. If indeed some indications of that come about, would it impact flows into EMs, APAC, and thereby the kind of demand that foreign investors have? Because hitherto India has been getting fairly decent sums of money. Could that change?
So we've just spent the last couple of minutes describing the incremental opportunity in the Indian market, particularly in certain spaces. And so we're very positive on some of the incremental tech that's coming to the market. We're very positive in particular on financial stocks, which is really the only sector in India still trading at average valuations. As you say, India has been the biggest outperformer in global emerging markets on a year-to-date basis. You've seen significant foreign inflows on a relatively sustainable basis all year. The market is not trading cheap. So we've talked about the opportunities. Let's spend a couple of minutes talking about the risks. I've just outlined some of them. The other risk that we do need to be aware of is just the impact of a very stable or strong US dollar on overall emerging market equity inflows over the course of the next 12 months. The expectation from a JPMorgan perspective is that you do get stable to a bid dollar as you start to talk about rate increases, you start to talk about an end of tapering in the United States. If I look at the central bank conversation across Asia, we had the Bank of Korea raise rates last month. It was the first increase that we've seen on a pan-Asia basis. We do think we'll see caution across most of the rest of the Asian markets, however. And so the base case scenario is we have an Indian market that's well bid, that is not trading cheap, that's seeing significant foreign inflow, justified. The risks to that scenario, however, are a stable to rising US dollar, combined with the fact, and we need to be clear on this, that analyst estimates for India for 2022 growth are punchy. And there is the potential to start to see some of these estimates being missed as we go into next year. So from a JPMorgan perspective, particularly off the back of a lot of the commentary that we're hearing off the back of the JPMorgan India Summit this week, there are still very interesting selective opportunities in India, but it's clearly time to be selective.
Clearly time to be selective. My final question, James, and it's my job to counter, so I'm not countering really, but just questioning that one piece that you mentioned, and which is the dollar strength, but the comfort that maybe a global investor might find in the fact that the central bank has been top of its game when it comes to manning this crisis, if you will, and the plethora of reserves that the Indian central bank has, because of which it can adjust to any sharp swings on the upside or the downside. Is that a comforting factor for a global investor or not really?
Yes, and I would add to that the fact that you've highlighted the monetary side. I'd also highlight the fiscal side in both India as well as China. And what we're seeing in both markets, interestingly, are government tax receipts running very, very significantly ahead of expectation, 25, 30% ahead of expectations. If we look at what that means, at least for JPMorgan forecast going into the second half, is we do expect a more positive fiscal thrust in both markets. To put some numbers on that in the India context, you've got the state government talking about CapEx in the second half up 30% year on year. It's a big number. At the state level, it's even higher at 37%. So yes, there are headwinds and risks, but we still see significant firepower in the coffers of the Indian government at both the central as well as the state level to further support this economic recovery that we're seeing in the industrial production, as well as some of the other macro statistics that we're seeing coming out of India.
So would James Sullivan be more tempted, while James Sullivan may be optimistic on India, would he be more tempted about an Indian market if it was trading maybe 5-10% lower?
I'd be more tempted to go in on very specific sectors. 5-10% off of the sectors that have been bid up so much over the course of the past 24 months, I think is probably not yet enough of an adjustment. You probably need a confluence of valuation adjustment, but also, as we just said, some adjustment in terms of earnings expectations before there was a degree of comfort to come in. But on a selective basis, we're still very positive on elements of the tech stack as well as on financial stocks.
Got it. James, this was lovely. Thank you so much for giving us a lowdown on almost all things that matter. Really appreciate your time.
Thank you very much for having me.
Now, the pleasure was ours. Viewers, thanks for tuning into this edition of The Talking Point.